2001. So here it's a make-believe society, ABC Society. It's a not-for-profit organization established in the year 2001, 20X1, could be 2011, could be 2021, depending on whichever decade we are living in. I just left it as X1. Its average revenues in the years 2001 to 2003 have been $400,000. So that may sort of remind you, yes, you watched something in the videos. We talked about the small not-for-profit organization exemption with regards to capital assets. For those that remember, the definition of a small not-for-profit organization is one whose average revenues for the current year and the previous year, okay, current year and the previous year have been less than $500,000. So sometimes I've seen people kind of get this, waylaid by this little red herring. Yes, its average revenues have been less, $400,000 in the past. But what the requirement for the question is actually is pretty simple: prepare summary journal entries. And so if that were the case, you don't want to start sort of second guessing yourself. The not-for-profit, the small not-for-profit exemption relates to whether when a capital asset is acquired, what the society can do. Normally, if a capital asset is acquired, we are supposed to record the asset and then depreciate it, right? Capitalize, amortize. However, for a small not-for-profit organization, as I explained in the video, they can capitalize and amortize like everybody else, or capitalize but not amortize. And thirdly, they could choose to expense the entire asset. All right, so I've seen people get a little bit flustered on that count. Unless that is explicitly mentioned or your opinion is sought, right? You're asked, okay, what are the options for this society? Then, if that were the question, that does ABC Society have any options with regards to its capital assets, you will disregard this bit, okay? You will focus on the transactions, and you will try to find out, well, what is the method being used? So the method over here being used is they follow the deferral method, and they use a single operating fund, okay? So they don't use fund accounting. The society does not use fund accounting, and they use the deferral method for recording contributions. All right? So we'll keep that in mind. The second example that we'd be looking at is essentially the same as example 1.1. In that situation, though, we'll make the assumption that the society follows the restricted fund method, and it has three funds: the operating fund, the capital fund for capital assets, and the endowment fund. All right, so we're going to look at the solution soon. Just wanted to go over the transactions. So in early January 2004, ABCS received the donation of land valued at $200,000 to be used for the construction of the ABCS Center. So this is a contribution of a capital asset, a non-depreciable capital asset, okay? A non-depreciable capital asset. So just a reminder here for the deferral method, if we get a contribution of a capital asset, we will initially record a liability, a deferred contribution liability, if the asset is going to be depreciated in future. If not, then what we essentially do is record the amount, the dollar value of the asset received as a direct increase to net assets. Yeah, I went over all of that in my video. So here goes nothing. Donation of the land, you will debit land for $200,000 and credit. Oh, hang on, this is a different one. That's my land. debit land, credit net assets, $200,000. Okay, does that make sense? Why did we debit land? Well, we got the land, right? We have to record the asset at its fair value. Why did we not credit revenue? Well, the receipt of the land under the deferral method, if we get a capital asset, we should initially record a deferred revenue liability and later on do a reverse match, right? We should do a reverse matching of revenues to expenses. Matching principle told you match expenses to revenues. Reverse matching is the opposite. You'll match revenues to expenses in the same period as they are incurred. The problem with land is never going to be amortized. Land is never going to be depreciated. So we'll never have a corresponding expense for the land. Hence, the credit must go to net assets. Net assets, remember, is like equity for regular businesses, similar to equity. Now, what about the restricted fund method? If you have the same facts, then under the restricted fund method, you will recall from our discussion in the videos or my description in the videos, you have to use fund accounting. So you have to pick up one of the funds. So this particular society, ABCS, uses 3 funds: the general fund, the capital fund, and an endowment fund. So land is a capital asset. It's part of property, plant, and equipment. So you will record this entry in the capital fund. You'll debit land for the $200,000. And rather than crediting net assets under the restricted fund method, you will actually record the value of the land received as revenue in the capital fund. So you'll actually record contribution revenue. Okay, so deferral method, you did not record the land as revenue. You actually recorded it directly as an increase to net assets. Restricted fund method, though, you will recognize revenue, contribution revenue, in the capital fund. So I went over that description, that distinction between the deferral method and the restricted fund method in the video. For those of us who maybe did not watch the video to its entirety, it was towards the end of that video, or not towards the end exactly, but definitely in the latter part of the video. It's chapter marked, so you want to maybe go back and take a look at that portion, all right? Going forward, that's what you will need to do, folks. You will need to watch the video before class. This is simply going to be the application of the lecture content to problems. So any questions so far? For the donation of the land, any burning questions? Record the asset, deferral method, because land is non-depreciable, credit net assets. Restricted fund method, credit contribution revenue. So now think about what will be the impact on financial statements. Under the restricted fund method, you will actually be reporting revenue for $200,000 on the statement of operations, which is like an income statement, right? Whereas under the deferral method, there is going to be no revenue recorded for the land. It will increase the equity portion, or the so-called equity portion, the net assets, but it won't get reported as a revenue in the statement of operations. So that's 2 very different outcomes, right? 2 very different outcomes. If we are good, then I hope you have the question opened and you're following along. The next one is, also in January, ABCS received a government grant totaling $600,000 of which 25% was for covering operating expenses for the current year, and the rest for the construction of the ABCS Center. So we got a total of $600,000 in cash. 25% of that amount was for a government grant. The rest was for, 25% was a government grant for covering operating expenses. The rest was for the construction of a building. Okay, so under the deferral method, you're going to record the cash received, right? So debit cash received, out of the 600,000, you got $150,000 for covering the current year's operating expenses. So that will be recorded as grant revenue. And the rest, $450,000, that is recorded because it's for the building, and the building is a depreciable asset, right? Because the building is a depreciable asset, you will want to record that amount as a deferred revenue. Deferred revenue is a liability, right? Deferred revenue is a liability, so you'll credit deferred grant revenue. And later on, when the building is depreciated, that's when there will be a reverse match, right? That's when revenue will be recorded. So initially, record the $450,000 grant for the building as a liability. The deferred grant revenue is a liability. Later on, there will be a reverse matching. Now, if you think about the restricted fund method, though, everything gets recorded as revenue immediately. The big difference, the big thing to remember, though, is that the $150,000, which was received from the government to cover operating costs, is recorded in the operating fund or the general fund. And the $450,000 for the building are actually recorded as revenue, but in the capital fund. Grant revenue, they're both recorded as revenue. Now, a word on contribution and grant. I recommend that you bifurcate, that you separate the amounts received from government grants from individual contributions. It's not a requirement. I just recommend it. In the standards, they say clearly that government grants are also part of contributions. However, if you think about it, government grant money tends to be not as erratic as individual contributions, especially when there's an economic downturn. Government grant money tends to be sticky. Government may reduce some of the grant money, but they will not completely reduce it to the point that it's completely insufficient. So even in the times of hardship, even as the likes of CBE and AHS will complain that they didn't get adequate funding, and they've got valid reasons, but it's not as if the funding got slashed from $1 billion to next to nothing. $1 billion might have been dropped by a few million, like 10 million, 20 million, $50 million. Still, for us, for people like us, yes, that's a massive enough amount, but it's not that grant money disappears completely. But think about individuals being able to donate, right? So I may have donated $1,000, say, to a not-for-profit organization when I was reasonably well off and was earning enough money. All of a sudden, if I find myself kind of struggling to find work, then I don't think I'll have the ability to support that charity to the same extent, right? It's not that my intentions have dried up, it's my ability. So individual contributions tend to be a lot more erratic, and users will probably like to get a sense of what are the primary sources of revenue, because government grants tend to be more stable, individual donations not so much. So my recommendation is that when we record these two very different sources of revenue, we distinguish between them. That we record government grants received as grants, whereas individual or corporate money should be recorded as contributions. Okay, So this in here is your second difference between the deferral method and the restricted fund method. Under the deferral method, the government grant for the building is recorded as a liability first, whereas under the restricted fund method, we record the government grant for the building as grant revenue in the capital fund. Okay, is it going swimmingly or you folks are completely at sea? What's up? I need some feedback here, guys. How is it going? Is that all making sense? Good so far, says Amy. Okay, thank you, Feroz. Thank you to Tracy as well. All right, then next up, we have construction of the ABCS Center was completed at a total cost of $800,000, using all of the government funds, with the rest coming from the society's own resources. And that was done by the end of June 2004. This building is estimated to have a useful life of 25 years, right? So we completed construction of the building. Well, guess what? We will need to recognize the asset. So in the books, we will debit the building asset at a cost of $800,000, credit cash $800,000. It'll be the same entry under the deferral method. You just have to remember to record the entry in the capital fund. Okay, same journal entry, like you can't come up with something new there. You constructed the asset. Okay, what do I have next? In late August, the society received a donation of equipment valued at $75,000 with an estimated useful life of 5 years. And that's the capital asset. We received the donation in kind. We got the equipment donated. We didn't get cash for the equipment. We got the equipment itself. So you may have seen, just painted behind, the handy buses. Uh, this handy bus was donated by somebody like you, right? So it's something like that. They got a piece of equipment that they probably needed. It's valued at $75,000. It will be used for 5 years. Brand under both methods, you are going to record the equipment at fair value. Right? This is a donation in kind. You'll recognize the equipment at its fair value, $75,000. However, given the fact that this equipment is a depreciable asset, it's got a limited life, so we will be recording depreciation on it. Under the deferral method, you will initially record a liability called deferred contribution revenue. Under the restricted fund method, though, you don't bother with the deferment. You record contribution revenue for the $75,000. You just have to remember to record it in the capital fund, right? The equipment is a capital asset. You got to record the journal entry in the capital fund. It's vital you remember to do that. The restricted fund method, fund accounting is mandatory. You have to use fund accounting. Deferral method, fund accounting is optional. You may choose to, you may choose not to. In this example, we chose not to, right? The society chose not to. But that is not a choice available under the restricted fund method. You have to use multiple funds. And what are funds essentially? As I mentioned in the video, they're basically separate set of records, separate books of records. A fund is capable of having its own revenues, expenses, assets, liabilities, and net assets. Basically, each fund has all of the various financial statement elements. think about it as analogous, I would say, to an operating segment that you learned about in intermediate accounting. You learned about segments. An operating segment is one that has its own assets, liabilities, revenues, expenses, and so on. A fund is kind of like that, that it has its essentially its own scope of operations. Now, there was an annual fundraiser in November. ABCS organized its annual fundraising campaign to raise funds for operating expenses for the current year. The campaign resulted in cash of $98,000 and pledges totaling $150,000. Relying on past experience, the management at ABCS estimates that 85% of the pledges will be collected by early 2005. So remember the two criteria for recording contributions receivable. The amount should be reliable, should be reasonable, should be estimable, first of all, and secondly, there should be reasonable assurance of collection. So both seem to be in play here. Fundraising costs amounting to $40,000 were incurred and paid for in cash. So there's quite a few things happening here. First of all, I think we can go with just the 98,000 that we actually collected. I'm going about it in a step-by-step manner. So for the 98,000 that we collected, record debit cash credit contribution revenue, $98,000. That will be the same under the restricted fund method. You just have to keep in mind to record it in the operating fund. Now for the pledges, because the two criteria have been met, reasonably estimated and, reliably estimated, reasonable assurance of collection, we actually can record the pledges receivable for the $120,000. However, because management expects that only 85% of the 120,000 will actually end up being collected, not sure, we set up an allowance for the remaining 15%. So credit allowance for doubtful pledges, just like allowance for doubtful accounts, right? Accounts receivable, you set up an AFDA balance. Likewise, credit and allowance for doubtful pledges for the 15%, and the difference you're actually able to record contribution revenue because the amount, the pledges are for, fundraiser was conducted for operating costs of the current year. And this is what Grant Thornton people were saying. Canadian Cancer Society, it conducts a lot of fundraisers. They are just not able to vouch or audit the completeness of those numbers. Okay. What about restricted fund method? Same darn thing. Just keep in mind it's recorded in the operating fund. Same journal entry. Now, we were able to do this because ABCS management has past experience with fundraisers. Relying on past experience, management says. So they must have been conducting fundraisers in earlier years. What if that weren't the case? What if this was the first time ABCS had organized a fundraiser? If that were true, there would be no basis for ABCS management to estimate how much of the pledges will be collected. So absent that basis, under both the methods, you will then not record the pledges receivable. All right, so stuff like this can sometimes show up in tiny case type questions. You're given some facts and they ask you, okay, what should we do here? You have to pay attention. Is there a basis to the estimate? So if it is clearly stated that this is the first time they're doing a fundraiser, then I actually have seen this happen. I wrote an exam question where I kind of gave the facts and said, they conducted their first fundraising. Management is confident that they will be able to collect 90%. And a few students still said, "Oh yeah, go ahead. They can estimate." Well, on what basis, right? If it's the first time you're doing something, you can be confident, you can be hopeful, you can be whatever. You have no basis. How will you prove? Like you actually have to show auditors what how you were able to come up with that estimate, your basis for that estimate. And if you don't have any history of collections in the past, then it's just not advisable to record the receivable, the pledges receivable. Because notice if you by doing this, so on the balance sheet, on the statement of financial position, what will happen? You'll be recording an asset of 120,000 less the contra asset of 18,000. So on the statement of financial position, you'll be showing pledges receivable at a net amount of 102,000. And on the statement of operations, you'll be reporting contribution revenue of $102,000. Now, because not-for-profit organizations don't pay taxes, they're not subject to taxation, what's going to happen is that the net assets also will go up by $102,000. Now, if these pledges were if there was no basis of recording them, what is going to result is overstated revenues and overstated assets. And you guys know this from very early accounting courses I hope that you took, that that is something you don't want to do. You don't want to overstate assets and revenues. That goes completely against the grain of prudence or conservatism. Okay? Now, this bit about the fundraising costs. Fundraising costs should be, at the very minimum, disclosed, but it's good practice to actually disclose them on the financial statements, the face of the financial statements. So for that, I recommend that you actually record the fundraising expense and credit the cash for it. Now, some of you may have been thinking, hey, if we did the fundraiser, why not just reduce contribution revenue for the amount of fundraising expense? And I know that in some not-for-profits, they actually do that. So again, just a bit of an aside, if this were a smaller not-for-profit organization, there actually are some professional fundraising companies that'll help a not-for-profit organization to do fundraising, right? Because they have a team of people that will call up using a list. So if you ever make a donation to a not-for-profit society, rest assured your name got added to a list, which then basically can be sold to others, and other society people will reach out to you asking for your help and donation and so on. That's just business practice. So it may be possible for not-for-profit organizations to actually hire an outside agency to do the fundraiser. These outside agencies actually charge anywhere between 30, 35, 40%. So up to 40 cents on a dollar, right? So fundraising costs can be pretty steep. Now, say if the outside company raises $100,000 and charge us $40,000 as fees, we will only get $60,000 net as the society. So it may be tempting for the society to report revenues of only $60,000. But the recommendation in the standards is that they should not do that. They should actually record revenues of 100,000 and then show the fundraising costs separately as an expense. And that is something that the Calgary Food Bank people do, right? Calgary Food Bank, if I go back to show you the statement of operations, they actually show development and fundraising costs. You see here development and fundraising. 2018, they had spent about $117,000. 2019, they spent $107,000. So they do report their fundraising costs separately. so that people understand that the money doesn't just drop from the heavens. They have to put in efforts to raise the money. Okay. Next little blurb, a local TV station donated free advertising time worth $20,000. Now, on a bigger scale, you might be thinking there's the hospital lottery, there's the stars lottery, those are all basically fundraising efforts. That kind of a lottery is essentially an effort at fundraising. Okay, that's you may have seen advertisements on TV, breakfast TV usually. Time is running out. You could win this house worth $1 million and this and that and whatnot. Um, Very often businesses will donate some of those, right? So the TV station donated free advertising time worth $20,000. So this is a donation in kind, right? So for donations in kind, we will record the revenue and corresponding expense if we will have otherwise paid for it, right? This is an important bit. When we get donations in kind, we will record them only if we would have otherwise paid for that particular good or service. So assuming that that is what ABCS would have done, under both methods, you would debit the expense for advertising and credit contribution revenue. Okay, and this is done in the operating fund. The restricted fund method, you record it in the operating fund. Deferral method, they're not using fund account. So it's the same journal entry, a lot of common things here. Debit and expense, credit or revenue. Of course, that nets out. So the net out-of-pocket cost for ABCS was zero for the advertising time, but they do actually report this fact on the face of the statement of operations. Okay. All right. Before Christmas, ABCS received a cash donation, $500,000 to be used to set up a scholarship. This cash will be invested in fixed income securities with the income generated to be used to pay out the scholarship. Now that is a quintessential example of an endowment. Okay, that's an endowment. And for endowments, you would debit the cash received, $500,000 for both the methods, basically. And then it's with the credit where the difference arises. Under the restricted fund method, you will credit contribution revenue and make sure you record it in the appropriate endowment fund. Yeah. So for the benefit of those that didn't watch the video, or at least that part, endowments are where you get a lump sum of money that you're not permitted to spend. You need to invest that amount. Any income generated from that investment can be used. So in this particular case, we got a lump sum, $500,000, where the donor said, invest this amount and use the income generated from that investment to pay out scholarships. All right, that's an endowment. So for the $500,000, there will never be a corresponding expense. Cannot happen. So under the deferral method, we cannot record a deferred contribution liability because there will never be reverse matching possible. So under the deferral method, just like a donation of land, you will end up crediting net assets. Okay, so endowments and contributions of non-depreciable assets are recorded as a credit to net assets under the deferral method. Not so for the restricted fund method. Restricted fund method, so long as you're using the correct fund, you could go ahead and record the contribution revenue. Okay, I hope everything is fine so far, or clean as mud. I'm not sure which way things are going. Things are a little bit quiet. All right, next up, we've got the society organized a raffle draw at its Christmas party. Members and patrons donated prizes worth $6,000 for this event. Now, the very nature of these kinds of raffle draws is that usually these kinds of prizes would not have been purchased, right? These are, things that people kind of do, kind of like organizing a potluck dinner. So people either want to come in for it or not. These are spur of the moment type decisions. So for raffle draw prizes, usually the treatment is that the not-for-profit organization will normally not have gone out and formally purchased these prizes. They just invite people, bring in something, right? If you have, maybe you have a bottle of wine, or so, maybe you have some 2-night stay at a hotel that you want to gift, something or the other, door prizes, that kind of stuff. But these are small ticket items. These are normally not paid for, and hence these tend not to be recorded as revenue. All right. Clear distinction between this and the advertising. The donated advertising, we said, we assume that they would otherwise have paid. Now, if that assumption weren't valid, you wouldn't have recorded this journal entry as well. If ABCS will not have advertised on TV, for which they got free advertising, then you will not have recorded the revenue and associated expense. Okay, so it depends on the facts. All right, next up we have end of the year adjusting entries, and I'm sure you folks have taken enough accounting classes to note that Arjinder, for both the building and the equipment, the building had a 25-year life, the equipment has a 5-year life. We need to record depreciation. Yeah. The building was ready by June 30th. So 25-year life, but for the year 2004, we'll only record 6 months depreciation. For the equipment, it's got a 5-year useful life. We received the equipment at the end of August. So that leaves us September, October, November, and December, 4 months to record depreciation. So here we go. For the building, you want to record depreciation expense, 25 years, half a year for 2004, that's 16,000. And that's going to be the same entry in the restricted fund method as well. Just keep in mind, record the depreciation in the capital fund. Everything related to the building must go to the capital fund. For the equipment, similarly, you would debit depreciation expense and credit accumulated depreciation on the equipment, $75,000, 5-year life for 4 months for the year 2004, works out to $5,000. Now this notice is exactly the same for the deferral method and the restricted fund method. The only thing being, under the restricted fund method, you'll record depreciation in the capital fund. However, under the deferral method, keep in mind when the equipment had been received as a donation, ABCS recorded a deferred contribution revenue liability. And as said, there will be a reverse matching of revenues when the related expense is recorded. The related expense is the depreciation. So since we have now recorded depreciation on the equipment, the society will also record revenue. So the entry there will be, you'll debit the liability, debit deferred contribution revenue, and credit contribution revenue, right? Debit deferred contribution revenue and credit contribution revenue. So that is done over the same basis as the depreciation. So we got the entire equipment donated. The equipment has a 5-year life. For the year 2004, we recorded 4 months worth of depreciation. Similarly, for the contribution, we record the contribution over 5 years. And for the current year 2004, prorate for 4 months. So if you ask yourself, how much did the equipment cost ABCS? Well, because ABCS received the donation, the equipment donated from somebody else, the actual cost to ABCS for the equipment was 0. Think about what this does here. If you're going to record revenue of 5,000 and an expense of 5,000, what's the net impact on the statement of operations? Revenues equal expense, no impact whatsoever, right? No net cost to ABCS. But what about the building? The cost of the building was $800,000. When we recorded depreciation, the depreciation worked out to $16,000. 800,000 divided by 25 years useful life and half a year's worth of depreciation. So $16,000. Now, how much was the actual grant revenue? How much was the actual grant that we got from the government? It was 450,000. The government did not pay for the building in its entirety. A portion of the cost of the building was financed by the society out of its own resources. So it did cost, the building actually did cost the society something. Yeah. So now when the society recognizes revenue, the debits and credits are fine. The debits and credits are going to be exactly what we saw for the equipment. You're going to debit the deferred grant revenue and credit grant revenue, right? But in terms of dollar amounts, do we put $16,000? Is that what reverse matching means, or something else? Now keep in mind the two things I mentioned. Did the building cost ABCS something? The total cost of the building was $800,000. The money they got from the government, $450,000. Did the building actually cost ABCS something? Feroz says yes. And I guess Feroz, you'd say the difference between the cost of the building, 800,000, and the grant money. So Hugo did the math and Feroz did the math as well, $350,000. So if $350,000 was the cost to the society when the building was constructed, then over its useful life, that cost ought to be reflected in the income statement, right? The statement of operations. For that to happen, it is vital to remember that when we do the reverse matching of the deferred revenue or the deferred contributions has to be over the same time frame as the depreciation on the asset. So the building is being depreciated over 25 years. Well, guess what? That deferred grant revenue will be recorded into revenue over 25 years. The building was depreciated for half a year in 2004. Likewise, the deferred grant revenue will be brought into revenue for half a year for 2004. The only difference you can notice is the base amount. The depreciation on the building is for 800,000. The grant revenue will be recorded based on 450,000. So if you did that math, you will get $9,000. All right. Now think about what this means for the statement of operations. They're going to show revenue of $9,000 and an expense of $16,000. The net effect of the two, revenue of 9,000, expense of 16,000, leaves us with net expense of $7,000. So Hugo and Feroz worked out the math for me. $350,000 was the out-of-pocket cost. Divide 350,000 by 25 years. $14,000, awesome. And that 14,000 is for a full year. So half a year will be half of 14,000, $7,000. That's basically what you're seeing, right? 9,000 revenue, 16,000 expense, net expense 7,000. And that's basically as if ABCS is recording depreciation for its share of the cost of the building. That's how it is ending up, okay? For the equipment, ABCS had no out-of-pocket costs, and you notice there's no effect on the income statement as a result. Revenue of 5,000, expense of 5,000, net effect 0. For the building, they actually paid out of pocket, and that is being reflected in the difference in the revenue and the expense amount. So my dear friends, that brings us to an end of examples 1.1 and 1.2. We've compared the deferral method to the restricted fund method. And we found that although there are many similarities, there are some subtle differences. And those differences are primarily for restricted contributions and for endowments.